Well, I don't know how about you, but I always, being a natural scientist from my background, feel again impressed with the real physics behind climate change and the actual figures, especially that one curve with the methane going up very steeply. Impressive, I think. Now, we heard the climate scientist. Before we dive into questions, would want to introduce the panel to you. To the right of Reto Knutti, we have Remy Briand. He's Managing Director and Head of ESG at MSCI. He's responsible for MSCI's ESG products and is a member of the firm's executive committee and chairman of the MSCI Index Policy Committee as well, which oversees all the major edits of the MSCI indices. Until February 2017, he was also global head of research for MSCI. So not just on ESG, but generally the whole research. Welcome, Remy. In the middle, we have Rachel Whittaker. She's a sustainable investing strategist at UBS. She's working in the CIO team of wealth management, the person responsible also for sustainable and impact investing at UBS Wealth Management, and is doing research on different sustainability topics there. Previous roles included senior sustainable investment research and communication roles in different asset managers in Zurich, but before that she was also a sell-side equity analyst based in London. And to my left, we have Peter Munro. He's Director, Market Practice and Regulatory Policy at the International Capital Markets Association. And Peter's main focus at ICMA has been the green bond principles, including market development and education, since he joined the organization about 2 years ago, I believe. Previously, he worked at the European Investment Bank, where he was responsible for marketing the world's first green-labeled bonds and the promotion of EIB's frequent issuances, not just the green ones, but regular ones too, I believe. So you see, we have a panel that is covering almost the whole investment chain, leaving the physicist out of this. And I would want to start with a few intro questions to introduce the panelists to you. And I will start with Rachel, as she is really, I would say, the last one in the chain, in this chain, bringing products to clients. And we know that UBS has as its goal to integrate climate and other ESG factors into all of its asset and wealth management, which seems quite an ambitious goal. I'm sure it's not just an easy path. What are the main challenges in this, Rachel?
Is this on?
Yes.
Yep. Thank you, Sabine. Yes, I sit in the Wealth Management Chief Investment Office within UBS, but I want to try and address this topic from the whole bank perspective, because we do have sustainable investment specialists who sit within wealth management and also in asset management, and we collaborate, and we also work very closely with our colleagues in the corporate centre who are addressing UBS's climate change strategy as it relates to our total operations. So, yeah, we do have some pretty ambitious goals about how we want to address climate change and address all sustainability issues and integrate them into our investment processes and the products and solutions that we're offering to our clients. And we had an interesting conversation just before the panel where we were talking about data. And I think a few years ago, I probably would have been sitting here saying, well, one of the biggest challenges we have is the lack of data, and it's patchy and it's not comparable and so on. But I think that situation has really changed. And actually, there's an awful lot of high quality data now, in part by some of the organizations that are dedicated to collecting and analyzing ESG related data like MSCI and like some of your competitors. And actually one of the biggest problems that we have now, one of the biggest challenges we face is cutting through all of that data that is there and identifying what are the most relevant pieces of information to our investment decisions. And what is the most relevant information not only to our clients and to the bank, but also that is relevant to what we're trying to achieve from a sustainable development perspective. So we could develop investment products or solutions that follow sustainability themes, very specific climate change related themes like energy efficiency, clean air and carbon reduction. We can construct portfolios that have low carbon, and these solutions can be scalable, they can be very liquid, and can be very attractive to our clients, but often tend to have fairly low impact in terms of what you achieve in the real world. And if we're looking at more impactful solutions, perhaps for the clients who have very high affinity for environmental issues, want to do something about climate change, they want much more engagement, they want more bespoke solutions. Often these types of investments they're more impactful, but they're less commercial, and it's harder for a big organization like UBS to make money from them. So in essence, the problem that we have is that our traditional client base is getting more interested in addressing climate change problems through their investments, but they're typically drawn to the kind of solutions that are very large and very commercial, tend to be lower impact. And the ones that have a very strong affinity and are looking for the very high impact solutions, generally UBS isn't in a position to offer those in a commercial way. It's very difficult for us to make money for them. So what my team is doing is trying to crack that nut, and we feel that if we can try and address that mismatch, then we would ultimately be very impactful, but we're not quite there yet.
So still quite some work to do to make even mainstream products very impactful with regards to climate change. Now, I think you're also building on research partners such as MSCI when you provide such services. Remy, you've worked for MSCI quite for a while, and you also were always part of the ESG field. How have you seen client demand change over the past years, and what were the main challenges you faced in maybe adapting to changing client demand?
Yeah, and it seems that the theme of the day is clearly good momentum and probably not enough. And that would be mostly also my comment, which is what we see really globally is a lot more question, focus, interest on generally on ESG, but obviously the environmental dimension would be part of the key, issue to be looked at. So that part is clearly the positive. On the other hand, how that interest or questioning translate then either in strategies and target to reduce the risk, or structural change in the portfolio, or even measurements of engagement outcomes, all of that still remain relatively I would say coarse, even if there is quite a lot of improvement. So, for example, the first most basic step, which would be to measure the risk in the portfolio and to get a sense whether a portfolio is more exposed to carbon or risk, or less exposed to carbon risk than the benchmark. That is, which would be probably the first step. That is not necessarily something that most institutions are doing. So they maybe have an intuitive sense that there is a risk and something needs to be done, but then the quantitative aspect, which is to even know whether you're more exposed or less exposed to the risk, is still in the infancy. And again, that is changing, but it's still the sort of the basic step. Now, a number of the sort of initiative have been, I would say, more top down in the good sense, which is even if the measurement might be imperfect in terms of the carbon risk, there are a number of institutions that have said the risk is just too big and I want to reduce it, even if I'm not 100% sure that my measurement is extremely precise. I still get a good enough sense that there is a problem to actually get into mitigation strategies in terms of portfolio construction. And that's where you end up having approaches that are typically under this low carbon strategy bucket, if you want, where you can do that either in active funds, or you can do that through passive low carbon index mandate. But in both cases, there are solutions that allow generally to reduce the carbon risk by 60, even 70% without taking a huge amount of short-term risk if you measure it by tracking error. So there are mechanisms to actually do something, and we're seeing more and more asset owners, in particular the large ones, to start, changing this. The last part, which is very, very new, and you mentioned TCFD, there is an element of reporting in TCFD, but there's also an element of trying to do forward-looking scenarios and stress test the portfolio, and that is the new frontier, because it's very hard to do, but we're starting to see some initiatives on that front.
Now, Peter, green bonds are definitely a field which could also be entitled as impact investing. At least some people do. Green bonds have somehow the intention of bringing money into green solutions. But if we look at the EU now starting to work on the taxonomy, starting to work on standards as well, my question would be, well, why does this happen? Have the green bonds that are out there on the market so far, have they not really brought new finance to green solutions? Were they really green? Why do we see all these calls for standards and new labels?
Okay, so thank you first of all, thank you for inviting ICMA along here. I mean, we're very grateful to speak to the Swiss community, and actually we're headquartered in Switzerland. So we have a feeling that, and we're now learning it today, that Switzerland as a financial centre has the 6th biggest carbon footprint. That's quite interesting, quite powerful. But to respond to your question, defining green has been one of the bugbears of the green bond market. There's no question about that. But that is why we want a taxonomy. Let's step back from this for a minute. I mean, there have been, if I may, I'll just pick up on a couple of themes that are mentioned earlier. You've asked as well, do we have high impact? Just from a personal experience, I looked at the impact of EIB green bonds versus generic bonds. On the back of an envelope, you can see there was a 20-fold differential. So even if you have a small asset allocation to an explicitly green financial product, you can have a disproportionate impact on your portfolio. So actually this point that Rachel and Remy have been addressing, once and we heard it earlier with Olivier, once you've dealt with the question of basic exclusions, which already gives you a big improvement, once you move into the high impact, as long as you are satisfied with the integrity of what you're buying and you have the data to verify the impact, then you're doing well. And this is what links us back to the taxonomy discussion, because there are taxonomies out there. Often they're not fully comprehensive, like the Climate Bond Initiative taxonomy, classifying green, difficulties in translating across borders, all that sort of thing. We all know that countries start with different baselines. So, in fact, if we then link to your other point, how do we get everything to flow into the right financial solutions? We need to know what we're defining in order to move forwards. We need a clear framework if we want rules and regulations that are supportive. If those are indeed necessary, then at least we need to know what we're dealing with here. So I think that the taxonomy is important. But actually, I think in a way the debate has even shifted beyond that in some respects, because we've been asking ourselves a lot whether these kind of instruments have impact. I'll just give you an illustration from our annual meeting last week in Hong Kong, and we were asking one of our members how they saw this in their organization. They said, look, this is not about the individual transactional level. It is about the change in mindset that occurs in an institution, the change in accountability that comes with issuing or investing in a green or social financial instrument. And I'll quote the head of BNP Paribas Sustainable Capital Markets team, who said, there is no doubt, underline no doubt, that BNP Paribas behaves differently as an organization, having issued a green bond and committed to doing so again. And what does that mean? BNP is now actively encouraged and incentivized, important, to fund green projects. So what we see is there is an organizational shift going on when people get involved in this market. So I think that's the sort of the high-level answer to your question. And then just to maybe layer on top of that a bit more detail about what this has meant for markets and if markets are kind of getting it and moving on. I would say yes. I mean, we heard earlier about the importance of architecture. Green bond, green bond guidance is emerging in a number of jurisdictions where we've got more than 10 important jurisdictions that have done it, and bravo to China and others, and ASEAN who have led the way. But you've asked about the EU. Well, the EU has followed quite closely, actually, what was done in Southeast Asia in terms of the blueprint, but is layering on top of that additional technology, if you like, to strengthen it. And we'll be working with the new technical expert group that will try and put that into place. But also important is the market infrastructure. It's important that there are indices out there, and Remy and others have been doing great work on that. In fact, MSCI is probably the most closely followed index for green bonds. We were having discussions earlier about how much we understand about the differentiators in that index between high and low impact. This is something that clearly the market needs to work on. But infrastructure is there. The growth is there. We all know about the growth of the market. And interestingly, for those of you who are asking yourselves, should I get involved? There was a survey last autumn of heads of DCM saying, which is your highest growth product in the next few years? And they said green and sustainable bonds are clearly it. So in other words, the question is not if, but more how and when.
If and how effective. I mean, you pointed out that it probably shifts the attention of investment specialists if you emit a green bond and they just have to look for new kind of projects. Now I would want to raise a question with the audience, so grab your mobiles again, please, and go to the same page as before. You can also just go to the SSF homepage and then choose the top tab, which is this event, and there choose the right tab. Here you have the address again. The question to you is, what do you think are the main barriers for the further integration of climate risks into financial decision making? And I'm sure now we can have the question up or the choices. It's lack of standardized data, lack of awareness and knowledge, fear of negative impact on financial performance, or lack of demand of the beneficiaries and clients. You find the choices on the website if you answer that. And in the meantime, when you make your choice, I would want to hear from Reto, having heard now what these organizations are up to against the light of the data that you presented to us, and maybe also against the comment that we heard from Simon Zadek before. Do you think there's enough happening in the financial community to address the actual physical challenges?
Well, it's hard for me to judge what's happening on the financial sector, but in general, it's clear that not enough is happening. I mean, we've had this information for 30 years, as I pointed out. We've had climate reports from the Intergovernmental Panel on Climate Change for 30 years. We have climate negotiations for 30 years. And basically, all we've agreed on is that we have a goal, right? We have a goal in Paris, and that's fine. But a goal in itself is not enough. We have to actually do it. So clearly, we're not on track to do it. In that sense, I'm kind of pessimistic. But on the other hand, if you look at how quickly things can change if they're economically attractive, I mean, if we shift from a view of burden sharing where people say, oh, I'm not going to do this if my neighbor is not doing it, if you shift from that to a case where everyone is doing it because it's interesting and it's attractive for whatever reason, even irrespective of what the others are doing, then things could potentially happen very quickly.
Mm-hmm. I'm sure. Thank you for this assessment. I'm sure we're now ready to have the view of the audience on the questions. So, what was your assessment? What is the main barrier in taking up climate change in investments? I'm sure it's going to appear in a second. There we go. Now that's surprising. The fear of negative impact on financial performance is seen as the largest barrier when it comes to integrating climate change risks. I must say I'm surprised. It's actually the topic I wanted to discuss with you anyway, the financial impact of it. Who has topical research on this? Maybe MSCI. Have you done research on the financial impact of taking climate risks into account?
Well, what we have is us and our clients. We've got quite extensive analysis on ESG in general, and obviously the climate component would get into that. The other relatively easy way to look at the question is just to track the indices. There are low carbon indices. They exist. They're calculated daily. So in a sense, there's a sense of it's easy to do. And generally the sort of element is that there's very little indication that people are losing money when they allocate or pursue ESG strategies, as long as there is a dimension of focusing on the material risk. So in the ESG space, there is also a dimension which is values driven, which is more projecting individual or institution values on the portfolio, and that is not in and of itself is not a financial criteria. So the conclusion on that side is that it's random, but when you actually look at risk and long-term risk, then there's generally a positive or neutral elements to that. So if the facts are not pointing to loss of performance, but obviously that's definitely a question we get and hear all the time. That's one of the biggest question mark. Yeah.
Okay, so in the view of clients, it still seems to be a reality. Do you hear these comments from your clients?
Yeah, I wanted to respond to this question because I'm actually not surprised at the answer, and I think everyone in this room is convinced that you can incorporate climate change or other ESG factors without affecting performance. But I spend a lot of my time talking to our client advisors within UBS. And these are very kind of conventional investors who many of them have not previously thought about sustainable investing. And actually the level of knowledge of sustainability is much lower than I expected. I joined UBS Wealth Management a year ago. The kind of conversations that I'm having are at such a very basic level, and there is a huge amount of concern that by investing sustainably or ethically or whatever terms they're using to describe it, or the perceptions that they have, there's a lot of concern that you are going to have to give up returns. And you can try and justify it. They try and think about if it's green bonds, there's all this reporting requirements that's surely going to cost money. That concern is definitely there, and we can show as much data as we like relating to the performance of sustainability indices compared with conventional ones. We can talk about the academic research and the often cited meta-study of all the academic studies over the last 40 years that show the correlation between sustainability and corporate financial performance. But with many investors, whether they're professional investors and advisors or they're our clients, they can't get away from that feeling that there must somehow be a penalty that you have to pay for doing good.
So still a lot of conviction to be done. How about green bonds? We know that most green bonds that are emitted are really oversubscribed. Does this have an impact on performance?
Yeah, I mean, it would be interesting to kind of disentangle what is exceptional performance due to excess demand and what is really linked to the fundamental factors. That would be a nice area of research to look at. But I mean, if you want an illustration from the green bond world, and we take Remy's indices, I mean, there are a number of studies out there pointing to the outperformance of green bond indices versus the global aggregate. I mean, if we look at the period, let's say the 3 years up to, let's say, October last year, we have a piece from one of the dealers showing that if you hedge it back into euros, you're looking at an annual outperformance of 23 basis points. Now, if you're living in euros, and we heard about the interest rate cycle, that is a lot of value, okay? If you're holding bonds at negative yields and so on, 25 basis points, 23, 25 basis points starts looking interesting. Also, Sharp ratios look a bit better. So investors who are worrying for risk-adjusted return, looking, well, the volatility is slightly higher on the green portfolio, but the return is so considerably better that you're looking at a better Sharp ratio as well. So those investors have got a fear factor of exiting these. I can tell you, if you need to sell a green bond, no problem, because there is such an overhang of demand. This is what we hear on the street. It is overwhelming. The problem is supply. Okay. Now, does this tell us something? We asked over 50 investors in our membership what they thought about, if they are really, buying these products, and overwhelmingly they said yes. And what's interesting also is they're mainly concerned about impact. And to address your point, their interest is in getting high quality transparency around impact. One of our key areas of work is on impact reporting indicators, and we're kind of gradually cycling through the sectors, the important sectors, to get this done. So I don't think there's any doubt in the minds of the more sophisticated investors that this train has left the station. The question is, how should they get on board and indeed avoid some of the pitfalls that could occur in terms of quality and execution?
I'd like to come back a bit on the topic of standards and the whole EU action plan that is now debated, and we already see first suggestions, regulatory suggestions, and would want to hear from the investors and the researchers of how they perceive the intention of really defining standards, let's say for low carbon benchmarks, for example, but also more standards on the green bond side, for example. Do you see this as positive, or is it too much of market interference? Maybe I start with the research provider. I mean, you're probably challenged by this when it comes to defining your low carbon benchmarks.
Yeah, so I would say the positive is clearly that, in particular for the EU initiative, is it's a statement that this problem needs to be resolved. There is essentially, again, a statement that the EU wants to help, and all of that is positive. I think there's still quite a lot also of uncertainty on then how the general goals will be implemented, and that's really where we'll have to see really how things gets translated. It could be very good, or it could be very quickly obsolete. It depends also in parts to the level of detail that the EU regulation wants to get to. My bias is more to stay, when you get to regulation, at a level high enough that you let the market forces implement the objectives, because there's also simply an element of speed, especially in the ESG space. Research advance quickly, concepts refine quickly, and so there is a bit of a disconnect between that speed and just the regulatory speed, which is much slower.
Mm-hmm. I think in the institutional space, and perhaps this also reflects the growth of, we saw earlier the statistics for Switzerland, the growth of institutional investors as part of the assets managed sustainably. The general level of knowledge around sustainable investment is higher than it is in the private wealth space. And from our perspective, as a wealth manager, a standardized taxonomy would be enormously helpful in helping to cut through some of the confusion that is there. And particularly as the sustainable investment industry has grown and has become much more mainstream, what we're seeing is many more players coming into the market, many more people coming into the field. And perhaps some of the quality of sustainability insight has been diluted as perhaps the investment focus has improved. And it's very, very confusing for investors to understand what's going on when they hear terms used in different ways by different organizations, when they see products that are named the same thing but look completely different when you dig below the surface. And we have tried internally to develop our own taxonomy, so that at least internally we can educate our client advisors and internally educate the clients into what some of these things mean. But to have something that's being developed at a regional and a country level and for the whole industry, would be enormously supportive.
Maybe also a comment from you, Peter. I mean, we see a bit of a danger of innovation being capped when you have such standards. How do you perceive it?
Yeah, I mean, at ICMA, we're big fans of voluntary regulation. That's what the Green Bond Principles are. We're also working across asset classes through a new vehicle called the Global Green Finance Council, which is set up fairly recently, which tries to think about these things cross assets, so we don't have an excessive encroachment of regulation. Now, I would share the sentiments that were just voiced. First, having a taxonomy can help remove uncertainty. Secondly, we want to be careful that it doesn't stifle innovation. In that regard, we're encouraged by the fact that the Commission's draft Green Bond Standard is following a blueprint that is very close to what the market has already put in place. The main difference is that they say require where we would say recommend. In a way, that's their prerogative. Also, they're trying to bring more integrity to the independent opinion providers on green evaluations and this sort of thing. And that's something where we've also brought out some new guidance recently. So actually, in a way, perhaps, at least at the moment, things are moving the right direction. And one final point, if I may, is that we also welcome the idea of a principles-based approach so that there is some flexibility in the system. Now, this is something the Commission has hinted that they will do, that they will include a principles-based approach in their classification. Let's see how it evolves. There is quite a tight delivery timeline until mid-next year. A lot of work still needs to be done.
Thank you for these opinions. Now, before we move on with the panel, I would want to raise another question for the audience. We discuss about climate change here now, and we all know a lot of the sustainability topics are really interlinked. What we hear sometimes is, does it make sense to actually have specific low carbon indices, or would it not make sense to just keep an ESG eye on all of this? Now, I would want to know from you, in your eyes, does it make sense to concentrate on climate risks within ESG risk assessment? And the answers would be, yes, climate risks are most material, so we have to focus on it. Or no, climate risks cannot be isolated from other important ESG factors. Please make up your mind on this question while I address the same question to the panel. I mean, we now discuss climate change. We know it's very pressing. The physics are there. But at the same time, can we leave other aspects aside? And can a Swiss institutional asset owner just focus on climate change, or do they have to take human rights into account as well? What are the client discussions you have resulting in? Do you really have clients that just want low carbon products?
Well, we're seeing both, and it could sound strange in a sense that some people focus only on the environmental aspect, and they don't want to do anything. Sometimes it's just a question of the own cycle of thinking and then implementation. But my personal view is that at the end of the day, if you want to resolve or solve for a more long-term sustainable investment, it's very hard to just focus on one dimension and make a definitive decision not to focus on the other one. In particular, the governance side has an influence generally on how company behaves, so I think it's hard to disconnect. But there could be just an element of priorities and sequencing in terms of how institutions want to deal with this problem.
In private wealth management?
Well, thinking about UBS as a group, actually, we have seen demand for single-themed investment solutions, but generally they do tend to be smaller, both in terms of the assets that they're able to gather and also in terms of the scope and the eligible investment universe for those strategies. And the types of solutions that have been more popular are the multi-themed ones that are addressing a whole range of sustainability issues. And perhaps this goes back to the point I made at the beginning that, my view is very much coloured by our position as a very, very large bank, and most of our client base are very traditional investors, and if they're taking their first steps towards sustainability, it's typically going to be into something that feels more like a conventional strategy that isn't too niche, and that's where the more general sustainable approaches are of more interest, and it's the smaller group of clients that are further along that journey who want the more bespoke and the niche products.
Well, we know green bonds are very much about the green aspect, but I know you have other bond principles too. What's their importance?
Well, we also have what we call social and sustainable bond guidance. Now, the sustainable part is, for us, it's a mixture of green and social. Now, we haven't tackled governance because, in a way, rating agencies have long been looking at that. But let me give you a couple of interesting data points. So, roughly three quarters of our buy-side members will buy social or sustainable bonds. Okay, so that is only slightly behind those who have an E strategy. So the differential is not that big anymore. That social and sustainable part has been growing in the last couple of years much faster than the environmental part, admittedly from a much lower base. And if we think about what kind of data they might be looking at from the, let's say, traditional sources of this information, the rating agencies. I was interested in a recent study by S&P, which was doing a look back at a whole range of ratings over a kind of 2-year horizon up to middle of last year, and they found close to about 350 ratings where social risks were an important factor, and over 40 cases in which there was a rating action where this was a key decider in the rating action. So we shouldn't discount social risk as something irrelevant, and indeed, of course, governance has long been a central feature of credit risk.
Maybe the view of the climate scientist. Do you think as a society we should actually focus on climate change because it's just affecting so many other fields, or do we have to find a balanced approach?
No, I think these things are clearly interconnected. Maybe on the mitigation side, if you get rid of the CO2, that's a pretty simple and maybe isolated task. But on the impact side, if you think about food, if you think about water, they are clearly very much interconnected with climate. And climate often makes these existing problems worse. Right, we can go as far as speculate about migration. The connection is not that obvious, but clearly these are linked, and the social aspects are very much part of it. So I'm not arguing that climate is the single most important one. I'm simply arguing that we should take the science that is out there on all of these aspects seriously when we decide about the world that we will give to the next generation.
Now we are interested in seeing the assessment of the audience. Should we have ESG products or just climate products? Well, that's a pretty clear picture. Maybe the SDGs have sunk in and really made it obvious that it's important to tackle a broad set of ESG factors. Quite impressive, I find. So, but it also supports your view that these topics are growing in importance.
Absolutely, and in fact, I'm glad you mentioned SDGs. I should mention that we just published a mapping to the SDGs of the Green Social Bond Principle because there was clearly a lot of demand for that. One should remember that there are some, let's say, more governance or social factors which are quite difficult to quantify, which can't yet be mapped. But clearly, these things are compatible, and I would say what's interesting for markets is that there is the potential to have convergence between these different financial solutions, and increasingly there is convergence. So again, in a way, there is no excuse for investors to say, well, the solutions aren't there. I think we can see from this group around the table, the solutions often are there. It's more a matter of getting to grips with them. And actually, one of the challenges we see, and we were discussing this in the coffee break, is the interdisciplinary challenge. So you are needing to bring together people who are finance specialists with, let's say, environment or social specialists, and maybe also lawyers who can figure out how the framework might function. So this is kind of a big challenge to bridge those gaps.
And maybe communication specialists as well. As we heard from you, you also deal with questions of how to actually effectively communicate the threats of climate change.
Just maybe also a comment on on that solution dimension, what I found very interesting in terms of change in the way people think over the last 5 years, let's say, is that 5 years ago there was still a norm with most people managing money that essentially their role was mostly to construct a portfolio, but that the rest, how the company would behave, or how they could initiate change was really not part of the definition. And that is true still, I think, quite a lot, in many asset management firms, probably in parts because they manage, money not from, themselves, but from the asset owner. But the shift has been quite dramatic in the asset owner space, either insurance companies or pension funds, where it's not only portfolio construction, but it's also how can you engineer a solution, and to a large extent an allocation to green bond is one step in that direction, but the thinking is very different. So you're solving for a solution, not just a portfolio construction problem.
Well, I would now like to give you the opportunity to raise questions to the panelists, and there's a microphone here. There's a first question there in the middle.
Yes, thank you, Alexandre Prout from Symbiotics. I'd like to ask a question about the outperformance of green bonds. Is it possible to express that differently in terms of yield differential between green bonds and bonds with similar maturities from similar industries? In other words, is there a premium the market puts on the fact that the bond is green?
Okay, that's a very interesting, important question. I would say in the primary market, the evidence is still kind of mixed. It depends which market you're looking at. It's much more evident in the secondary market. So one of the reasons, why is this? One of the reasons is that, let's say, conventional thinking about fiduciary duty has prevented people from accepting some kind of differential pricing. Investors have been scared about overpaying for a green asset, for example. But as we know, we heard about it maybe happening in Switzerland. It's certainly on the agenda in Europe. Fiduciary duty and sustainability, these two things look like they're going to be integrated. And in fact, it'll become mandatory, I think, in the EU to consider sustainability in assessing the suitability of an investment for your client. Now, that's quite a major shift. In fact, we're even, according to the EU timetable, by middle of this year, by the end of this month, we're supposed to have some news on what the EU is doing in that space. So this is actually happening quite fast. So our feeling is that once the fiduciary duty question is addressed, that'll leave investors more flexibility to think about differential pricing in the primary market. And given the overhang of demand, it wouldn't be surprising to see that. And there certainly are examples, anecdotally and also analytically, and there is research available about this from the Climate Bond Initiative, for example, together with some partners, showing that there are pricing differentials sometimes in the primary market. But again, it's a mixed, depends. In the more evolved and advanced markets, you might see a bit more of this, and in the higher impact cases, maybe more of it. But yeah, this is the status.
With regards to fiduciary duty, we had some conflicting views on the panel, on the previous panel, but actually the Swiss Federal Council gave signals in the direction of including the attention to ESG factors as part of the fiduciary duty. You wanted to comment on it?
No, I was just going to follow that up briefly with the kind of the view of our credit analysts, our very conventional, traditional credit analysts, who are very firmly of the opinion that in the primary market there is no reason why there should be a pricing differential. It's very hard to measure it unless you have the same issuer who's issuing a green bond and non-green bond with an identical profile at the same point in time. But in general, the way that the green bonds have moved over the last sort of 5 or 10 years since they've been around, it doesn't give us any reason to think that they should perform differently. Of course, we haven't been through a really difficult market environment where green bonds could have been challenged, and we do see some potential there that maybe the type of investors that are drawn to green bonds are perhaps going to be slightly stickier, which might support the green bond market a bit more. But a slightly different view.
So no clear picture yet. I believe there were some other hands up. There's one here in the front.
Hi, I'm Preeti Sinha with Financing for Development. My question is for the professor, Reto, because I want to talk about carbon sequestration and your view, because you presented very interesting research. But how about carbon as an asset, and like a company like Covestro that does like 80, 90, 100% research on that?
So I'm not exactly sure what the question is about, how to sequester carbon, or whether that's...
Is that a possible solution?
So in principle, it's possible. Technology exists. The problem is at the moment it's expensive, and it requires a lot of energy. So at the moment, it's far, far cheaper to not emit the carbon than to emit it and then take it out of the air and sequester it. The second problem is a question of scale. Right? We're emitting something like 30 billion tons of carbon per year. Right? So, I mean, we're debating on where to put a few pieces of nuclear waste since, I don't know, 30 years or 40 years, and we cannot agree where to put them. It's probably less than this room. Now we're talking about 30 billion tons per year. Right? I mean, it's an awful lot of material that needs to go somewhere. Where do you put it safely? And then the third question, is that socially acceptable? I mean, would you like to have 1 million ton under your house or not? Right? So there are a number of question marks here. But the reality is that a lot of the scenarios that go to 2 degrees and 1.5 degrees, they do include that as an option, not today, but sort of in 2050, 2070, the assumption is that at some point it's going to be cheap enough or cheaper than do other things, so it's going to be part of the solution. But there's no way that it could do everything. So emitting business as usual and then sequestering everything, that's not going to work.
Maybe a follow-up question on that. There is this book called Drawdown, pointing out solutions that are economically viable and are meant to also act as a sink. Do you think these are useful solutions? Have you heard of them?
No, I haven't. I haven't read the book. Is it?
Yeah, it's a book by an
about?
American, and it was brought up in our network and promoted as a potential investment opportunity as well. Maybe someone else can comment on it.
So I'll have maybe a more provocative view, which on carbon capture, I think it's borderline a moral hazard, in the sense that, you know, and you see it in what's very interesting looking at some of the forward-looking scenarios that are put out there. Usually the oil companies, even in their most, you know, aggressive scenario, the 2-degree scenario, for example, from Shell, you know, recently, essentially the way they model it is, let's emit, you know, and then 20 years down the road, there will be a miracle, you know, a very cost-effective carbon capture solution, and then carbon will disappear. And in the meanwhile, let's continue to emit, you know, and so the question from an investment standpoint is whether investors should wait for that miracle or deal with, you know, maybe other solutions that are more proven. And I think that's, to me, the question on carbon capture.
Mm-hmm.
I agree it's a problematic way of thinking about it because we don't have the technology really in a scale that we need it. But to be frank, it's the only way to get back. So once this thing is emitted, it stays in the atmosphere for hundreds of years. And even if you stopped emissions today, climate change would not disappear. It would just stay, right? It's basically irreversible on any human relevant timescale, hundreds of years. So the sequestration is the only way to get this back if we decide that we have gone too far. So I think it's worth doing the research and figuring it out.
And maybe what was encouraging about your figures is that the estimates in terms of energy consumption or renewable energy being installed were always too conservative. So sometimes innovation actually helps and makes the whole development faster than we can expect. So let's hope for the best there. Now I give a last question to the panelists before I to let you think about it before I take further questions from the audience, I'd like to think you about what you would wish from one of the other parties at the table. We have academia, we have research providers, wealth managers, and industry associations. What would be a wish from you to one of the parties to make integration of climate issues in investing easier? Think about this. Now 1 or 2 more questions, one here and then one there.
Yeah, this is a question for Peter. You said earlier that the Climate Bond Initiative taxonomy might be a little bit too strict, or the development of technical standards may not be fast enough. Fair enough. On the other hand, isn't there a risk that tagging bonds to the SDGs that cover 17 areas, very diverse, going from education, healthcare, affordable and energy, basically achieves the opposite effect, which is to turn this bond issuance space into a gigantic greenwashing machine?
Yeah, thank you. Optimistic question. I think. Don't misunderstand me. I mean, I'm not saying that CBI is too strict. I'm also not saying that SDGs are the panacea. I'm saying what we should do is harness the different sources of investment momentum and bring those who, for example, interested in SDG investing to the table, and then confront them with the other filters that they will need to go through. And we work very closely together with CBI, and we've been great champions of their work. And I think what's interesting is the kind of dilemmas they face. For example, they recently brought out some commentary on green building standards. Now, it is possible to get a green building label without actually making meaningful GHG reductions, okay? And then you ask yourself, and in certain jurisdictions. So the problem is, when you have an international standard, you've got a lot of complexity to deal with in terms of local standards. And this is what I was alluding to, the fact that having a one-size-fits-all solution is neither realistic in terms of the baselines we're working from, nor desirable. We need to have tailor-made solutions which work for the different markets. So, in a way, to respond to Sabine's question, my ask to the panelists would be for Reto and actually others on the panel to give strong input to those who are framing the new classifications, so that they are flexible enough and also pertinent to the different geographic and sectoral differentials. And that's really, when one has these large EU panels, there's quite a high execution risk given the complexity and the time frame. So it's very important that those who understand these things give input at the appropriate time to keep us on the right track and avoid some of the kind of scenarios that Eric has kindly raised.
Mm-hmm. Thank you. You already brought us to the last round, and in terms of timing, I will actually stick to this and just move on with Rachel. What is your wish to one of the other groups?
Okay, keeping it very brief, I think my biggest wish would be around the industry frameworks question. I think that would make the biggest difference for us in terms of taking more sustainable investment solutions to a much broader client base.
Mm-hmm. The question to Remy.
Well, obviously, the audience is definitely, as we've seen before, biased. So my message is more to the audience, which is, it's been a long journey, and with a lot of questions and questionings and questions about, financial impact, etc. But it has been also a journey that has led to change and a creation of momentum. And I think there is an element of having to continue to push for, generally the integration of ESG, push for solutions and push for change, because it does have an impact. And I think that's really, again, this audience is probably has contributed and can contribute to that effort.
So in other words, going back to your desk tomorrow morning and work hard. And the last word goes to the climate scientist. Your wish to the financial community?
I think I would be interested in having a a more in-depth discussion in how to provide input. So, I mean, we've established the basics. We're now working on what we call climate services, which is essentially the weather forecast for the next 20 years, right? I mean, you know the weather forecast, and everyone knows how to use it and what it can do, and it has been developed over a long time to fit the user needs. And for climate, the problem is not really that we don't understand climate, but we don't really understand what the clients need, right? We don't understand what you all need. And for us to make an impact, I think it would be useful to sit together and have a discussion of how we can help you so that you can do a better job. I'm not asking for money, although if you have money, that's great, but just an interesting discussion on how that could be a better collaboration.
So this is definitely something that Swiss Sustainable Finance can take up and hopefully help to liaise. Well, please join me in thanking the panel very warmly for their interesting contributions.